معرفة.
So if you look at, when I was in practice, legal practice, I was at Muhammad Ismail and Co. And at that time when I was hired by the Islamic banks to do the documentation, I felt, surely, the bankers could have done much better than this. Because all the Islamic bankers were doing is trying to design the Islamic products in accordance with the norms of conventional banking. So you take a conventional, say, syndicated loan, and you tell the lawyer that, look, I want this conventional syndicated loan to be structured Islamically, but the economics should be the same. So if the tenor is 5 years, here will be 5 years. If the pricing is 5%, Islamic banking syndication will also be 5%. If the risk is credit risk only, secured by collateral, other guarantees, you will also need the same thing. So I was a bit frustrated as a lawyer, and when I had the opportunity to be on the banking side, I thought I could do a lot of difference. So it was very exciting. I felt that, probably now, having seen the constraints on the legal side, maybe I can do much better on the banking side. So I went to banking, and after more than 16 years, I find that the same challenges prevail today, if not greater. So when you move to banking, you find that, well, you may want to explore different structures that involve, say, profit and loss sharing or risk sharing, as we say. The issue is, like the lawyers, where the instruction comes from the banks get the instruction from the end user. The corporates come to us and say, look, I want financing, Islamically structured, but I would not pay more than what I would pay for a conventional loan. So if I'm paying 5% for a 5-year conventional loan, I would also pay only 5% for a 5-year Islamic financing. So when the pricing is dictated by the market, the end users, you find that in life the pricing has to match with the risk. The risk and reward has to match. If the client is only prepared to pay 5% for 5-year financing, you cannot do a risk sharing, because the 5% pricing was based on the conventional loan, where the conventional lender or bank is only taking credit risk of the borrower. That means if the business of the borrower fails, he has full recourse to the borrower and the collateral and the credit enhancement he has received. So since the 5% is priced on credit risk analysis, Islamic banks, when they also get the same mandate to do Islamic financing but at 5%, they have no other option but to structure the Islamic financing to shadow the conventional credit profile. So Islamic financing, we will buy the asset, we will sell it to the customer at 5% profit payable on a 5-year term. The end result is we are taking the credit risk of the customer. The customer's business may flourish, we are not going to get a higher return than 5%. If the business diminishes, we are not going to get less than 5%. So while the industry tries to make changes or tries to aspire to make a difference, the market dictates that I want 5% pricing, or I want a pricing which is similar to conventional. So the pricing is the biggest challenge, and the expectation of the customer is you must meet the pricing or lower. Now we can't be lower than the market, otherwise you will be creating what we call an arbitrage. People will be moving to Islamic because it's cheaper. But then the depositors will say, I want the same price as conventional deposit. So while depositors come to us and say, I want to place 3 months deposit with you or 1-year deposit with you, they always look around, shop around for the best rate on the conventional side. If the conventional banks are paying 3% for a 5-year deposit, they will say, for a 3-month deposit, they will say, give me the same 3% for a 3-month Islamic deposit. So as a bank, you have a 3% cost of deposit, and you have to receive 5% from the financing. So it's very difficult to maneuver. You can't pay less to the depositors or charge less to the customers, the obligors who are taking financing from you. So the ultimate, the ultimate test is, are the consumers prepared to pay or prepared to share the risk and the reward for being an Islamic transaction, for entering into an Islamic transaction? Are they prepared to pay a higher reward for sharing the risk? So ultimately you find that the banks are intermediaries between the savers and the users of funds. So the savers of funds dictate. They want to protect their deposit. They want the banks to protect their deposits. For a risk sharing platform to work, What is risk sharing? Risk sharing means the savers are sharing the risk with us. They're saying, this is my savings, I want you to go and invest and share the risk with me. But we're not seeing that kind of depositors. Whenever the economists, Islamic economists, come and say that, look, why are you not doing risk sharing? First question I ask is, have you put your savings in risk sharing, Mr. Economist or Professor? I always ask the professor, you want to do risk sharing, how much of your own savings you have put in risk sharing? Right? So far I have not seen any customer with deposits coming and saying, let's do risk sharing. So the challenge is to get savers to say, I don't want the protection, the deposit protection you get in all the countries, the deposits are protected. When you get deposit protection, that basically stunts the appetite, basically kills the appetite for risk sharing. So why would someone, Muslim or non-Muslim, saying that, look, I will forego the deposit protection by the state, and I'm now going to give my hard-earned savings to an Islamic bank to share the risk. When the deposit protection is available, nobody wants to share the risk. So when the risk-sharing appetite is killed at the inception, Islamic banks are forced to protect the deposit. They have to pay on demand whenever the customer wants. So they have to structure their financing. They can't have, on one side, all the deposits are protected and on demand. You have to return the exact amount on demand, and you are then forced to go for risk sharing. The mandate is not there. If all the depositors come to an Islamic bank and say, here are my savings, you put in risk sharing, put in mudaraba, put in musharaka, then the Islamic bank can go and invest in mudaraba and musharaka. But when the depositors are all unanimously saying, I want my deposit to be protected, I want it to be liquid, anytime I want the money back at the principal amount, then I have no mandate, zero mandate to go and invest the deposit in a risk sharing or Sharia-based product. So it has to start from the deposit side. And one of the reasons why the risk sharing is not growing is because people have other alternatives. Right? Muslims often would not go out and buy non-halal meat because they will look for halal meat. But when it comes to financing, they wouldn't mind putting the money in a non-halal deposit. It is an Islamic deposit is often a nice to have instrument as opposed to halal chicken. It's a must have. So Muslims often make a distinction when it comes to financing. They will go out of the way to get halal food, but will not take the effort to put their money in halal. I'm not generalizing, but that's the experience we've had in many countries where people are indifferent towards halal or non-halal financing. It is changing though, but it will take some time before the shift happens to become truly Sharia compliant.
معرفة.